Hi, in this short video, I'm going to talk to you about the tax changes that were brought in that started in April 2017. They're going to run through for 4 years to get them fully in place. And it's called Clause 24, also known as interest rate relief changes, mortgage interest rate relief changes. It's the main tax change that affects property investors. And this video is really here to help get rid of some myths, debunk some myths that are getting in the way, and to give you some clarity so you move forward with purpose and get on with investing. Because property investing is outstanding. It gets you great results if you understand it and do it properly. And people are panicking because of the tax changes, or it's making them fearful and it's giving them an excuse not to move forward. Notice I say excuse. We should never live with excuses. We should live with ownership, accountability and responsibility. We should own our decisions. And part of owning that is understanding the tax, which this video will help you to do, and then moving forward with purpose and with a vision. Okay. And my other videos can maybe help with some of that. So who does this actually affect, and how does it work, and you know, what's the impact of it really, bottom line? So I want you to understand, first of all, if your income by 2021 will be £50,000 or less, the Clause 24 tax changes do not impact on you at all. And if you're in a couple and your income is £100,000 or less as a couple, and you set things up properly, Clause 24 does not impact you at all. So, you know, a lot of people I speak to might have, one of the spouses is earning $50,000 a year, the other is a homemaker earning nothing, or, you know, maybe earning $10,000 a year, and, you know, they say, what do we do? Well, you can set things up, and I'll cover it at the end of this video, using a deed of trust, and basically use both people's allowances up to that £100,000 threshold. You just need to know what you're doing and know how to do it. So more on that later on. But if you're £100,000 or less as a couple, or if you're an individual, £50,000 or less as an individual, stop worrying about it. It does not impact you, does not change anything. Okay. If you're going to be over those thresholds, you're going to be over £50,000 or over £100,000 as a couple. If it's minimally over, impact's not big, just get on with it. Okay. But if you're already, for example, a 40% taxpayer, and then you've got your properties on top, and then this is going to impact you, then you need to be thinking about it. You need to be making some decisive decisions about what you need to do to minimize the impact of this tax change. Okay, so what do we need to cover? Well, first of all, how do you work out what your income level is if you've got your own employed or self-employed income and property income? Well, the way that the new changes work is slightly different in how you work out your income threshold. So you take your employed income. Let's say somebody was on £30,000 a year of employed or self-employed income. And that's before tax. And then on top of that, you take the properties that you own, you take the rent that comes in, you knock off all the costs apart from the mortgage. So you can knock off the letting agency cost, you can knock off the insurance that you pay, any maintenance costs. So let's say, you know, I rent a property out for $600 a month, and then my costs going out are about $200 a month. So I'm left with £400 a month before I pay the mortgage. So that's about £5,000 a year. So if I've got buy-to-let properties like that, okay, maybe in the Midlands or the North in that example, they're worth £5,000 a year. So if I've got 4 of those, my £30,000 plus those 4 would get me to 50. I'm fine. If I had 5, I'm just tipping over, I'm fine. If I had 8, now I'm tipping over quite a lot. 8 lots of 5,000 is 40,000 plus my 30. Now I'm at 70. Now these tax changes are going to start to really to bite and to impact me. Okay. Now, by the way, if I'm just starting out and I'm on 30,000, I would buy the first few houses still just in my own name. Now, I'm not an accountant. I'm speaking to tens of thousands of people on this video, and I can't know all your personal tax situations. I can't know where each and every single one of you is. So I can only give you a framework to then go away and speak to your accountant about, okay? But as a basic principle for 98%, let's say, of the population, if you're under that 50,000, until you get to it, keep buying in your own name. So 30,000, I buy another one, I buy another. When I hit 50, then I consider what to do next, okay? Now, I say 98% of people, if your income, your personal income is going to grow beyond 50 pretty quickly, you know, you've got a growing business or you're getting promoted all the time and you're going to go through it, you know, you're going to keep these houses for 40, 50 years, but within 3 years, you're going to be beyond 50,000 personal income. Then you might consider what I'm about to talk about. okay? But if in principle you're going to keep earning the same amount of money, same type of money, you buy them in your own name until you hit that threshold, okay? Now, if you're the other end of the scale, so if you're already a 40% taxpayer through your income and your properties you already have, or just through your income you already have, then for 98% of you, buying in a limited company is going to be better. Putting the properties in a limited company rather than just your own name will be the best structure for you. Now, there are advantages and disadvantages for that. In a limited company, while you're growing the portfolio, it's a great place to hold them, because in a limited company, corporation tax, the government have committed to getting that down to 18% payable, whereas in your own name, you're paying 40% tax on your profits, so your rental profits and all that kind of thing. However, if it's in the limited company, the properties belong to the limited company. So when they go up in value and you release some equity to buy some more, or to spend on a holiday or have some fun with, it's the limited company that has the money, not you. And it costs money, costs dividends or tax potentially to get it out. So if you're in growth phase and growing your portfolio for 10, 15 years, a lot of 40% taxpayers are like, well, this is an investment for the future. I don't need the money now. Limited company can be awesome. And then when your personal income drops in 10, 15, 20 years when you retire, then you can start to draw out using dividends and take the money back out of the limited company that you own. Okay? But it's great to grow in that limited company. If you're a 40% taxpayer, but only for another 3-4 years, because then you're going to be retiring, and then you'll spend another 30 years of your life, I hope, we want to live that long, another 30 years of your life with a lesser income, then you might take the hit today and buy in your own name. That's the 2% I'm talking about, might buy in your own name, because longer term, over the longer term period, you can spend a lot more years under that threshold. So I wanted to just give you a feel for that. There are also strategies that you can use if you're somebody who is in that threshold already, that 40% threshold, and you've already got property. So this is impacts on you. People say, well, what do I do? Do I move my houses into a limited company today? How do I handle this? What do I do? And I can't, in a short video like this, cover that. So what I've done, I went and interviewed 5 of the leading property tax accountants in the UK. I believe in mastery. So whenever I'm teaching something to my clients, I want it to be the best advice. So I go to the masters. I went and interviewed 5 of the leading property tax accountants. And I said, look, what do we do if this is our situation? Because with 200 properties, this is definitely my situation. And they came up with 10 strategies that you can use to minimize the impact. Okay? And, but I can't cover them on here. It takes a lot longer to cover. So what I've done is just below this video, there's a link. Okay? And if you click that link, it'll take you to my tax webinar, which takes about an hour and 15 minutes to watch, but it goes through this in absolute detail so that you can understand this fully and make some real great decisions for yourself on how you should be managing this going forward. So if this is something you need to manage and to master, go watch that webinar, and that will give you enough information to be in a great position of power when you're speaking to your accountant to ask the right questions and to get yourself set up properly with this. My final piece of advice is you're an accountant a property tax expert? You see, when I started out investing in property, I started out and I went to my business accountant to set up my property stuff. He was an expert in business, really good at that, business accounts, but I didn't know, but not an expert at property. So my first 6 properties I bought in the wrong structure. And when I got around real professional property investors that knew what they were doing and they explained the structures, I realized I was doing the wrong thing. So these days I only take advice throughout all my life in property from people who are real, true experts that are doing it themselves, walking the walk, talking the talk, but the expertise in that area. So you need to make sure you're working with a property tax expert, not just your local accountant or the one you've always used because it's convenient. So they fully understand this stuff. But once you watch the full video, if that's of use to you, you can then make sure you're asking the right questions and checking you're working with the right people. Okay. So my final message is, these tax changes, if you're over that 40% threshold, yes, it does cost you a bit more in tax. Okay? If you're below it, it doesn't. So stop worrying. But bottom line, versus any other investment in the UK, there's no other investment where the banks will lend you 75% of what you need to buy something. You buy stocks and shares, you have to put all the money in. You buy £100,000 of stocks and shares, you have to pay it all. The bank won't lend you any money. It goes up 10%, you make 10%. In property, they'll lend you 75% of the money. So you have to put 25% in. If it goes up 10%, you actually make a 40% return. So get on and buy property. Do not. I'd rather you bought 5 properties with the wrong tax structure because you'll still be making great money than because you're not sure about the taxes you don't buy any. So get on, take action, buy some property. Bottom line, invest with knowledge, invest with confidence, create financial freedom. I'll speak to you soon. Thank you. Hi guys, it's Aaron here. Did you enjoy this week's video? If so, there are 3 things you can do to continue your property investing journey. The first is you can click here and subscribe to my YouTube channel. I really hope you do, because then each week I can keep sending you great educational videos just like this one, so you can keep developing your property knowledge. Secondly, you can click the link here and get a free copy of my book, The Property Coach, where I teach the 9 steps to really truly successfully building a property portfolio. The third thing you can do is click here and go to my website, www.aaroncurry.co.uk. And there you can subscribe for free to my newsletter. And what that means is you'll get loads of free educational content in lots of different forms. And also any of our promotions or offers that we run are also there on the website and also in those e-newsletters. Again, helping you move forward with your property investing journey. So if you want to take action, just click any of these 3 boxes or all 3 and move forward to the next level. And in the meantime, invest with knowledge, invest with confidence, create financial freedom. Thank you.